There are a ton of trading patterns out there, and unfortunately, most of them fail most of the time because they evolve into something different, but by that time, it may or may not be too late for you. So which pattern can we use that is extremely consistent, showing up every single day and every single week? But real quick, I need to explain the 4 phases of the market, which is also going to perfectly explain what this pattern is, just using some different terms. But before I continue, if you would like this slideshow, it is down in the description below. It is free to download off of Google Slides. That way you can download it. Follow along with me in this video. It's yours forever to keep. So the 4 phases of the market: accumulation, markup, distribution, markdown. Accumulation is just sideways consolidation down low. Markup is essentially an uptrend. And usually that uptrend is going to come in the form of 3 pushes. Sometimes it'll be more obvious than others. Other times it might be a little bit more blended, but in most cases, or a lot of cases, you'll see some kind of clearly defined 3 stair steps into a level. A sideways consolidation, which will be your distribution. Essentially, it's just the opposite of your accumulation. This one's up high, this one's down low. And then you have your markdown, which is the downtrend, and usually that's going to come in the form of 3 legs as well. Now, this pattern can show up over the course of weeks, days, or even just on the day itself. This pattern shows up every single day in some form or variation. Whether you know it or not, it's there. Now, these 4 phases are the Wyckoff market cycle, essentially. And these phases have been identified in the early 1900s, and pretty much every system since then has used some variation of this market cycle. And so we can kind of see that here. And like I said, it can take place over the course of multiple days, or maybe hours, or on the day itself. But in this case, we're looking at an entire week, how we had a accumulation and then a markup coming in the form of 3 legs or 3 pushes to the high. Notice how the market then tends to go sideways, holding in between a high and a low. And then we start to break back down, and then now we're getting our mark down. And you can kind of tell just by looking at how it moved over here on this day, you could tell that it moved in very defined 3 legs into the low. That's just how the market tends to move in those 3 push patterns or 3 level style of patterns. Of course, it can happen over the course of 3 days, which is how I tend to look for these setups over the course of 3 days, and we're going to talk about that here a bit later. Learning about 3-day setups from Stacey Burke from his channel, of course, which you should definitely go and check out. These 3-day setups are usually going to be high profitability, large, fast moves, and that's why I look for them. But you can also have setups on the day as well, which we're going to talk about. Looking at this pattern, though, you have your accumulation phase, your sideways consolidation down low that breaks out and goes up towards the high. And just like that other example where it happened over the course of multiple days in 3 legs, this happened over the course of 2 days in 3 legs. So you can see leg 1, leg 2, leg 3 to the high, and then you get your double top opposed to your double bottom. So you have your double bottom down low for accumulation, 3 legs up, double top, we go into distribution, sideways consolidation, drops down, and then now maybe we're looking for a lower high to start our mark down phase in the opposite direction. A nice little pump up, consolidation at the high, and then a dump back down to where that pump began. On the day, you'll be able to spot these patterns. They won't always be perfect, not always at the certain time of the day, but we're looking for the patterns that are perfect and that are very identifiable. And in this case, notice how they've triggered previous day's low, and we're going to talk about identification and characteristics of a good pattern later on. But hint, hint, this is one of them. If they trigger certain levels and then pump the market back up or dump it back down, that is usually going to be my indication to be watching that pair. And I'll say that again for the purpose of anybody taking notes or maybe who wasn't paying attention the first time. When they trigger certain levels and then pump the market or dump the market, in this case, they triggered the low and then they pumped it. If they triggered the high and dumped it, that could be an indication for me to watch that pair on the day. So in this case, we have our double bottom accumulation phase. They've triggered previous day's low, and we get the breakout back up towards the upside. And it came in the form of 3 legs to the high, kind of a consolidation, leg 1, leg 2, leg 3, sideways consolidation, drops it down a level. And then now we can continue in 3 legs back down towards the low. And you can kind of see how it moves in those legs. Drops down, goes into consolidation, leg 1 down, consolidation, leg 2 down, consolidation, leg 3 down, in the day in consolidation. If you've ever studied like BTMM, Beat the Market Maker, he talks very frequently about this cycle within the day and within the week. Sounds very similar to Wyckoff, but this is it. Looking at the accumulation markup, distribution markdown. Hey, sorry, just had to catch your attention real quick. I do giveaways every single month. All you have to do is comment something down below. It could be anything. Nice shirt. Where'd your mustache go? Chicken. It doesn't matter. Okay, we're going to talk about some important details when looking for this pattern. And I'm going to, if you don't feel like this is functional information yet, I've got it coming, I promise. Some important details. A lot of times, in a high percentage of cases, it comes back to where the pump or where the dump began. So if we have a day that has made a lower low or triggered a certain level and we're looking for it to pump back up and then dump back down, in most cases it's going to go back to at least where that pump began and maybe even expand the range. So this range here, the high and the low of this range, it may expand it down, or in other cases, of course, to the upside. So this is a recent example. This was oil on the 14th of February, 2025, and we had a low of day. So basically what happened here is we were pumping up into the high, and we got the lower low. So we get a lower low back down on the inside of the previous day's range, and then they pumped it back up into the high 3 times, and it starts to break down. And you can kind of see that even though this is just on the day, we have the 3 peaks back up. So in 3 legs, the sideways consolidation, and then they drop it down a level, just like all of those larger patterns. And then they drop it down and they pump it back up a little bit more, and then it starts to collapse. And the verbiage that I'm using here is going to be very important for future examples, and also once we start talking about what to look for. But we got the lower low, they pump it back up into the high, and then drop it down a level, go sideways. And this is about where I started entering right here after this bar. And then the follow through back down to where the pump began is where I started getting out, and where I ended up getting out completely. This is also another very recent example. This was US 30 on the 10th of February, 2025. And for context purposes, this is a down moving market. This was a breakout day. The previous day closed in breakout to the downside, which could indicate a down moving market. We won't worry too much about that in this video, but the triggering of the previous day's low could be an indication for me to look for it to pump back up, so that we can essentially look for a trend trade. The market is in breakout to the downside. Oh no, it's in breakout to the downside. So maybe I'm looking for a breakout pullback sort of scenario. In this case, they triggered the previous day's low, which is my indication to look for the setup, making it more high probability. And then we have our accumulation phase down low as well from the previous day. And then we start getting our markup. They start working back up towards the high once, twice, 3 times to the high. They drop it down a level, and then they go vertical back down to almost where that pump began. So in this case, great opportunities to get in up high, great opportunities to get in on the follow through. But either way, this was a great trade. Let's just talk about the cycle a little bit more. Trigger the low, pump it back up towards the high, and then go vertical back down towards or to the low. I'm going to give you the cheat sheet very soon. I'm telling you right now, this slide alone is going to save you at least 100 hours within your study time. And because it'll give you something extremely good to go and look for consistently every single day, every single week. Look for this pattern. Okay, just you could save this slide. This is the cheat sheet, the master sheet for what to look for every single day. So you can go back, don't take my word for it, and study these behaviors, and you should get an extreme amount of value from doing those studies, but also just knowing what to look for obviously is pretty important. Common important details. We're continuing on with this. After a structural break. Now I need to explain what is a structural break. I've got plenty of videos on my channel about structural breaks, higher highs, lower lows, how to identify those objectively, how to use the previous day's high and low as structural breaks, as well as using the high and the low of the day as a structural break. But after a structural break, the market always goes back for a retest in some way. Now, sometimes those retests will come in the form of, let's say that we're making lower lows and lower highs, right? And we make a higher high. Sometimes that retest will come in the form of a higher low, or sometimes it'll come in the form of a lower low. So let's kind of get something up there, and I'll show you exactly what I'm talking about. So for example, if we have a market making higher highs and higher lows, and we get a lower low. Now, it's not always going to make a lower high, all right? Sometimes the retest of the high will come in the form of a higher high, which can be very confusing because it becomes a question of, well, is it going to just continue? So this is where we're watching the behavior at the high if this happens. If they go back to retest the high, number one, I'm looking at how that happened. Did they get there in a stair-stepping motion and then just barely trigger the high, and then did that high ultimately fail? That's one thing that I can look for. The next thing I can look for is, did the retest of the high come in the form of them coming outside and going outside of the high in 3 legs and then failing immediately after? That is another thing that I could look for. Or otherwise, I can just look for, in most cases or a lot of cases, it'll just be a retest of the high in 3 pushes. So we're making higher highs and higher lows. They make the lower low, and then they go back and try to retest the high in 3 legs or 3 pushes. And then that, once they engulf back down to the downside, I can say, okay, hey, this is a lower high now. It's been confirmed that this is a lower high, and I can look to take my trade based off of this pattern. So with that in mind, coming back to the cheat sheet of what to look for each day, for example, if we have, let's say, a lower low, we're making higher highs and higher lows, and then all of a sudden we get a lower low in the market. That is a structural break to the downside. We could look for a lower high and then to look for follow through to a lower low. We could also have a higher high that ends up with a lower low, telling us to watch for the setup. And then they go back for that higher high, which is like I just explained. And then now we can look for that higher high to fail and follow through back down towards the downside for a lower low, back to where that pump began, at least. There's some trap variations because sometimes, you know, they'll do this and then they'll just keep going to the upside, and it's like, well, what happened? So if they break out of that high again, basically turns into a breakout pullback and they just kind of keep going. That's where you have to be very careful, not to be jumping the gun, getting in front of a moving train, because maybe a higher time frame is driving that market and you may have just missed something. In other cases, you'll have lower lows, higher highs, higher low, and then a higher high. So lower low, higher high. That's the break-in structure. Higher low is the opportunity that I'm looking for, that engulfment, and then going and getting in on the higher low to make and go up to make higher highs. Same thing as this, but in reverse. Sometimes you get the lower low, a higher high. They'll come down for a lower low. And then I'm trying to get in on the failed lower low to go back up to make higher highs. Of course, there's trap variations of this theme as well. And of course, I wouldn't leave you all hanging without giving you pictures. So here we go. We have a lower low in the market. This is this was not only a lower low, but this was also the low of the day prior to a session beginning. This is a lower low because this was the low of the day prior to a session beginning. They came down and spiked into that low. Here's our accumulation phase, the sideways consolidation. Notice how they're all on the inside of this 1 bar's high and low. And this is all on the inside of that. And then it breaks out. And then we get leg 1 out. Pulls back, goes up for leg 2, and pulls back, and then goes up for leg 3. I don't know that this is going to be leg 3 until we get the engulfment bar back down to the downside. They drop it down a level and go sideways. So you can kind of see the consolidation up high having been built, accumulation, distribution, marked down, and then now we're going to make new lows. So if we're going back to that cheat sheet, back over here, which variation are we currently looking at? We were looking at a lower low, higher high, lower low, lower high, and then going to make lower lows. And then on the way down, we can observe the exact same behavior for the markdown phase. We have leg 1, leg 2, and leg 3. Yeah, but Cameron, how on earth do you actually go and apply this? Because they show up all over the place. So, when do I actually use this? The practical answer and the simple answer is always. Because every single time there is going to be a trend move or a reversal in the market, it's going to develop as one of these patterns. So on the day, going back to kind of like the cheat sheet, if we're making higher highs, higher low retest, higher high continuation, this is on the day. This is what I'm looking for on the day to confirm certain things. Higher high, lower low retest, higher high continuation, kind of going back to the cheat sheet, right? Lower low, lower high retest. You can read through this. I'm not going to read every single one. This is in combination, as always, with looking for those 3-day setups. And one of these 3-day setups is going to come in the form of, let's say market is going up and they trigger the previous day's low at some point. That could be the signal to look for it to pump back to retest the high, to go back to the low. I'm going to say that again. If we're making higher highs and higher lows and they trigger the low, that could be an indication to look for over the course of 3 days for them to pump the market back to retest the high and roll over. Not always, but in a lot of cases. Same thing in the opposite direction. If we were going down for multiple days and then we trigger previous day's high, that could be the structural break to look for them to retest or go back to the low in one of these forms, and then look for it over the course of 3 days to reverse and go back up towards the high to where that dump began, which you can read here. This is another slide that you really should save and go and observe these behaviors. Previous day's high and low is the trigger. Trigger previous day's high or low. Again, these are structural breaks that could indicate to look for a certain type of setup. You could even look for these structural breaks on the day. So for example, if we have a market that was, in consolidation, maybe we're at the high of the week, they trigger and break the previous day's low, and they go back to retest the high of the day in this case. And how did they get there? We had accumulation down low after the lower low was made, sideways consolidation on the inside of a 1-bar range. There's a low, there's a high. All of this is on the inside. We get the breakout. Notice how they break out here. We get 1. Notice how they pause. And then they break and continue to go higher. And then they pause again. And then they break and they go higher and go back sideways into consolidation. So now we have a 3-push stair step to the high. We've triggered previous day's high after making a lower low, consolidation, and now we go into the markdown phase. Once we get bars to the downside that will confirm, we can go and start making new lows. Push 1, leg 1, 2, leg 2, leg 3 in the day in consolidation. So a normal daily cycle. Here is the cat again in a down moving market. And we have the previous day's low having been triggered. So previous day's low being triggered in a down moving market could be a lower low on the day, or just in general within the week. They've made a lower low, and then instead of just breaking out and continuing, they trigger the low, making the lower low, go back into consolidation, and then they start to pump back up towards the high. And just look at how they've done this. The behavior, bars, real small. Accumulation, big bars. So maybe now we're convincing people to start going long. Leg 1, leg 2. Notice how they pause in between each one. The acceleration, the pause, the acceleration, the pause, the acceleration, and the sideways consolidation that doesn't go anywhere. Push 1, push 2, push 3, and it drops it down a level. So the same exact pattern. Pump it up, sideways consolidation, drop it down a level, go sideways, and then go vertical now for the mark down phase. And then we get the same exact pattern. So now we're making lower lows and lower highs, 1-bar range, high, low, accumulation, breaks out. Now we're making lower lows and lower highs on the day, and we can follow through and continue to make lower lows and lower highs, maybe for a low-hanging fruit trend trade, something along those lines. If you didn't catch the initial drive, just ways of watching the adaptation of the cycle and of the actual pattern, so that way you can act appropriately as things continue to play out. So where do I actually look to get in on these types of trades after the low of day, high of day, something like that has been triggered? This is the pattern. All right, they trigger the low. We go back up for a lower high. This is them going back to retest the high of the day in a lower high form. Where do I actually look to get in? So for all of these, whenever it drops it back down a level, or in a long scenario, they break out and they go into that first level, my goal is always to try and get in on this first pullback before it goes vertical towards the downside. Now, if I miss this first pullback, maybe I'll wait for a scenario like this for it to pull back one more time, and then I'll try to get in on the second pullback. But my goal every single trade is to never try and chase these bars. That would be a FOMO sort of scenario. I am only looking to get in after they have pumped it back up or broken back out to the upside for a long scenario. So I'm not chasing bars, chasing moves, anything like that. I am only looking to get in essentially on pullbacks to trade the trend continuation, or in some cases reversals. But this is, we'll call it the master pattern. Structural break, lower high, lower low, structural break, higher high, and then follow through to a lower low. Go back to that cheat sheet, check it out. Hopefully it helps, and I will see you in the next one.